Hello everyone. Welcome to another video on our channel. Today we are going to explore a fascinating topic: the impressive growth of DeepSeek users and its impact on the tech sector. What you see on screen is a dynamic chart showing how this application's users have grown throughout January. This chart was created from the image appearing right now, and it represents the revolution this Chinese startup is generating in the world of artificial intelligence. DeepSeek is a startup that has captured the attention of the entire tech sector. Its artificial intelligence assistant, developed with a fraction of the budget of giants like OpenAI, has proven to be just as effective or even superior in some key metrics. This achievement not only challenges established leaders but also shows us the potential of more accessible and affordable innovations. In this video, we will analyze how this growth is putting tech stocks trading at high valuation multiples at risk. It is important to mention that DeepSeek's growth is not an isolated case but part of a broader trend in the tech sector, where startups are challenging giants with more efficient models. DeepSeek's ability to compete at this level with limited resources raises interesting questions about the future of the industry. Are we entering a new era where efficiency surpasses financial might? DeepSeek's popularity has already had a notable impact on financial markets. According to a Reuters report, global tech stocks have recorded significant declines. The Nasdaq dropped 3.1%, the S&P 500 fell 1.85%, and major names like Nvidia, Microsoft, Meta, and Alphabet suffered important corrections. In Europe, the tech index experienced its worst day since October. These declines reflect investors' fears of a possible revaluation of the sector, especially when most of these companies trade at extremely high P/E ratios. The impact is not limited to the United States. In Japan, the Nikkei also experienced drops due to exposure to major tech names. Companies like SoftBank, known for its investments in tech startups, lost more than 8% in a single day. This global scenario underscores how a disruptive innovation like DeepSeek's can have far-reaching effects on financial markets. It is worth mentioning that these declines are also raising questions about the behavior of institutional investors. Many of them, attracted by the explosive growth of the artificial intelligence sector in 2023, might be reconsidering their positions due to the uncertainty generated by DeepSeek's model. This highlights the inherent volatility of the sector and the importance of diversifying portfolios. DeepSeek's model stands out for its efficiency and simplicity. Using only 2,000 Nvidia H800 GPUs, which have significantly less capacity than the latest generation ones used in the United States, they managed to train a model with 671 billion parameters for less than $10 million. In comparison, companies like OpenAI spend over $100 million on similar projects. This approach not only reduces costs but also democratizes access to artificial intelligence, allowing advanced models to run on standard and even mobile devices. Additionally, DeepSeek's hybrid architecture, which combines reinforcement learning with chain-of-thought reasoning, represents a significant advancement in how AI models process and generate information. This type of innovation could change perceptions of what is possible with limited resources, challenging the notion that only tech giants can lead in this field. Another point to highlight is the potential impact of this efficiency on other sectors. Technologies like DeepSeek's could be adapted to solve problems in areas such as education, healthcare, and small businesses, sectors that have so far had limited access to advanced tools due to prohibitive costs. DeepSeek's growth poses significant risks to tech giants. While its model is not designed to compete directly with data center services like AWS or Azure, it does represent a threat in areas such as mobile assistants and desktop tools. The high valuations of companies like Nvidia amplify the impact of any correction, and this situation could serve as a wake-up call for investors betting on dominant narratives without considering associated risks. Another important aspect to consider is how this development affects investors' perceptions of tech supply chains. For example, Nvidia and other chip manufacturers have been considered pillars of growth in artificial intelligence, but models like DeepSeek's could reduce dependence on high-end hardware, negatively impacting their revenue projections. Additionally, the shift in market dynamics could accelerate a reconfiguration of strategies among major tech companies. Businesses that previously prioritized massive investment in hardware and data may need to reconsider their business models and focus on operational efficiency to remain competitive. For investors, this scenario underscores the importance of diversifying and carefully evaluating market narratives. While volatility is high, there are also significant opportunities for those who carefully analyze these trends. DeepSeek demonstrates that innovation does not always require exorbitant budgets, and this could open new doors for startups with more efficient models. However, it is also a reminder that narratives can change quickly, affecting the most overvalued sectors. From an investment strategy perspective, investors should consider not only short-term opportunities but also how industry changes may impact long-term valuations. For instance, companies that have built their business models around demand for advanced hardware may face challenges if more efficient models become the norm. In this context, there is also an opportunity for investors to identify companies that directly benefit from reduced artificial intelligence costs. Companies developing applications based on more accessible models could lead the next wave of technological adoption, especially in emerging markets. Looking ahead, the tech sector could face a period of increased competition and valuation adjustments. DeepSeek not only puts pressure on big tech companies but also opens the door to a broader debate about how innovation and success are measured in the sector. Companies that can adapt to this new dynamic are more likely to thrive, while those relying on inflated narratives may face painful corrections. It is important to highlight that the democratization of artificial intelligence has not only financial implications but also social and economic ones. More accessible models could accelerate the adoption of advanced technologies in emerging markets, reducing entry barriers and fostering innovation in regions that have traditionally been on the margins of these advances. The key question now is how tech giants will respond. Will they adopt these new methodologies to stay relevant, or will they continue investing in traditional approaches? The answer could define the competitive landscape in the coming years. In conclusion, DeepSeek is proving that innovation can come from unexpected places and with significantly smaller budgets. Its meteoric growth raises important questions about the future of the tech sector and the risks of high valuations. This is a crucial moment to reflect on how value is built and preserved in the market. Before we finish, I invite you to watch our video on the S&P 500's performance without the Magnificent Seven, where we analyze how these large companies have influenced the index. Thank you for joining us, and see you in the next video.